Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name is Randy Smith, and I'll be your host today. And really excited to have August Biniaz with us. August is the Chief Investment Officer of CPI Capital. He's also the podcast host of Real Estate Investing Demystified. So, August, welcome to the show.
Thanks for having me, Randy. Looking forward to this.
Outstanding. Well, let's jump right in like we always do. Can you give the audience your perspective on what's going on in the market and the economy and how you think that might be impacting the passive investor?
Absolutely. I mean, we're in very interesting times. The U.S. currently has a new administration in the office that's really, creating a lot of change. Depending on what perspective you look at it, that could be positive or negative change in the opinion of many. And so that's affecting the world, geopolitically, affecting the U.S. politics, affecting U.S. economics, and what have you. Very interesting time. But really, the story, in my opinion, for where the economy is at today begins with where we're at, in my opinion, which is a post-COVID era. We had this pandemic that came through, and global pandemic that affected not only everyone's lives, but also the economy, everyone's livelihood. And we're in that somewhat of a post-COVID era where the central banks around the world had to print a lot of money to keep people happy and keep people fed. That resulted in inflation worldwide. And then most central banks had to increase interest rates to combat inflation, which resulted in some distress in the economy and in business, which also affected real estate. Real estate has beaten the equities markets over the last century because of the fact that we can use leverage in our space to buy real estate. So when the cost of that leverage, the cost of that debt goes up, it affects real estate. And particularly speaking about passive investors and in this alternative space, which is outside of the public markets where you can invest with a fund or a REIT or a private REIT or a syndication group, be it multifamily or other asset classes. A few years ago, bridge debt got very sexy, got very the norm. Bridge debt is meant to take you from point A to point B until you stabilize a property. So it's not meant to be the premier or the standard type of debt you put on. It's the name is on it. It's supposed to be a bridge debt, but a lot of people, the syndicators, were using bridge debt to finance their deals, and because that would push up the economics. It gives you higher leverage. It gives you less stringent process of getting qualified for that loan, and a lot of people syndicating these deals, even funds, even larger groups. I mean, the Blackstone had to give the keys back on some of their assets to the lender. So they were putting these types of mortgages on the property, which when the Federal Reserve started increasing rates at such a rapid velocity, it causes some distress. In most cases, lenders required investment firms to put something called a rate cap, which is an insurance policy. If the interest rates go above where your strike point is, where you're purchasing that insurance, they required the borrower to purchase a rate cap. But those rate caps have a terminal date. They expire at some point. And what would happen is that the investment group has to now repurchase a rate cap, which the cost is astronomically higher than where it was initially purchased. So a lot of syndicators kind of found themselves in a difficult spot. It also created where the market has been since post GFC, where a lot of groups were buying properties pennies on a dollar. They were just riding the wave. This happened on large institutions. A group that we know has done $5 billion of transactions. They've recently have lost hundreds of millions of dollars of LP equity, which is all over the news and what have you. And that's because they just got complacent. They got used to putting these types of debt on the deals, getting high leverage, pushing up, financially engineering those LP economics, but then finding themselves in trouble. Hopefully, a lot of these groups can learn from their mistakes and come back stronger. And that has also created somewhat of a cautious environment for LPs. LPs are looking at either themselves having been involved in capital calls, or they are involved in a situation where they've lost their equity, or if they haven't, they're hearing others who have. So it's created some caution in the space. We felt that on our last deal that we closed last July, and we're currently on a contract on a deal as well. The sentiment has got better now, obviously, because the rates have finally stopped being increased and have come down. But that's kind of my thesis on where the economy is and where we came from.
That's an amazing summary. You covered everything from economics to this change in administration to what's going on in the current market. So fantastic summary. Thank you so much. It really sets the stage nicely for what we're talking about today. And this will be published in probably mid-April. So that kind of sets the stage. So let's kind of take a step back if we can, August. Can you tell the audience a little bit more about yourself? I gave a very high-level overview of who you are, but clearly you're well-educated. You've got a ton of experience. Tell the audience who we've got with us here today, if you can.
Yeah, of course, my pleasure. I've been a real estate guy most of my career. I have started as a real estate agent many years ago, residential real estate agent, and really transitioned from being a real estate agent to being more involved in deals. If it's, I was doing small fix and flips, buying a property, fixing it up and fix and flipping it really. And then from there, I moved on to start my own general contracting firm. And I was started focusing on building custom homes and spec homes. Custom home is when you build a home custom made for your client. Spec home is, the name is in it, really speculation. So you buy a lot, you build a home, and you sell it on the market, hoping to get the best price for it. So I was doing both of those for nearly a decade. I always wanted to scale. I always wanted to do bigger projects. My dream was one day to build a high rise in the downtown core of the city I was living in, Vancouver, Canada. And but I always felt I was limited to the amount of equity I had access to. I understood debt, but I didn't understand equity. I didn't understand that equity could be syndicated or you could put together funds. I always felt that was more on the institutions that could do that a private individual could never venture into that space. And when I would kind of explore, everything was so convoluted that it didn't make sense. It was too big for me to be involved in. I was a home builder. I should have just stayed in my lane. But post 2013, when the Job Act came out in the US, the regulation loosened up a bit. We had similar regulation in Canada as well. That regulation loosened up that people could actually syndicate deals and putting deals together and advertise these deals on social media and other means, which resulted in billions of dollars coming into this alternative space. So people were not just had one option is to buy stocks or go with what their financial advisor was saying, which is stocks and bonds. Now they could invest in these early stage companies or they could invest in a real estate deal and actually get a seat right next to a developer. Developers are always made into these companies or individuals who are involved in building great things. So now an investor, a doctor, a lawyer, an accountant, a high income earner could sit next to a developer or an investor, be it value add or development, and participate in the great gains that were available there. As I was going through my journey, I started kind of researching online, listening to a lot of podcasts, watching a lot of YouTube, reading books, and learn about this amazing space of raising money, putting together funds, and kind of went down that rabbit hole. And I realized it exists, and that was really kind of the impetus for me co-founding CPI 5 years ago, and which initially was the idea was allowing Canadian investors to have exposure to U.S. multifamily in particular, which has been one of the best performing asset classes under the commercial real estate umbrella. The only other asset class that has been in multifamily is industrial. So we wanted to allow Canadian investors to have exposure to U.S. real estate, particularly multifamily. And we had to go through a difficult process of understanding the cross-border taxation and compliance and what have you. So that's a bit of background of how I got involved in real estate private equity, as is also known, and allowing Canadian investors. But now we have a lot of U.S. investors that participate with us as well. We have offices in Florida. I live part-time in Florida. Both of my sons were born in Florida. So, and our U.S. investors, the numbers are growing at a higher velocity than our Canadian investors. Obviously, we're always going to service Canadian investors long term because of, so much things we've learned, and it's a great market here. But yeah, I feel long term, we'll have more U.S. investors in our funds that are Canadian investors.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
I love it. Yeah, and thank you for walking through that. It gives a better perspective on where you're coming from. And I love to hear that you spent 10 years as a developer working in real estate. That really gives you a lot of credibility, I would say, as you're coming in and starting to do value add programs. You bring that construction experience with you. So it's not the first project you've ever project managed before. You've dealt with these type of issues, so supply constraints, all of the challenges with personnel and employees. So great to hear that. So I'd like, if we can we dig just for a moment into this bringing Canadian dollars into the US? I've heard that can be really challenging. There needs to be entity structures that are unique to that. So I'd love to hear that perspective and see if that's something that you've also considered leveraging for other international investors coming into the United States.
Yeah, no, absolutely. So just a quick caveat right at the beginning. If you have your US investment firm and you have one or two Canadian investors looking to participate, it doesn't really make sense to change your structure and go through the hurdles that exist to bring one or two Canadian investors. In our case, we started out here, we have thousands of Canadian investors as part of our database, hundreds of Canadian investors who've invested with us. So it made sense for us to create the right structure for it to serve our Canadian investors. So that out of the way. Yeah. So, the simple stuff to give you bullet point number one is if you're raising money in Canada, you have to adhere to Canadian regulators and securities regulation that exists in Canada. So you have to be compliant on that side. You have to be compliant also on the US side where you have your main fund or your master fund. And when I talk about a fund, a lot of time in our space, funds are separated from syndications, from REITs and what have you. But when I say the word fund, I just mean it's an entity that has some money in it. It could be a college fund, or it could be a real estate fund, or it could be a syndication fund. For our deals, every time we syndicate a deal in the US, we have our US master fund, which is just a US entity, a US limited partnership. And then we have our Canadian feeder fund, which is our Canadian limited partnership. We use limited partnerships because they are a better structure. We don't even have LLCs in Canada. So LLCs are this hybrid entity between a corporation and a limited partnership. But larger funds like Blackstone funds, many of these large private equity funds that are created, KKR, Carlyle Group, Apollo, a lot of these private equity firms, when they put together a fund, is always structured in most cases, a limited partnership. So a limited partnership has been around since 1957. LLCs have just become sexy in a recent time. So a lot of times these deals are not structured in LLCs. They're actually structured in limited partnerships. So compliance on both sides when it comes to securities regulation. You have, you're choosing the right structure that makes sense, the right entity. So in our case is limited partnerships. And then now you have taxation. You need to make sure that it's, your structure is tax compliant. You're paying your taxes on the US. You're making sure that you're paying your taxes in Canada. You're making sure that your Canadian investors or international investors are not double taxed, that the taxes that have been paid on the US are recognized by CRA, Canadian Revenue Agency, or any other international body for international investors. Tax compliance is one part of it. When we realized when we did our first couple of deals, the big pain point that our investors had was that they didn't want to deal with IRS. They were already dealing with the CRA. They were already dealing with the tax man. They didn't want to have to every year also deal with the IRS. So the structure we created avoided the investor having to deal with the IRS and having to file taxes. And the way we achieve that is that the Canadian fund files for taxes on behalf of the Canadian investors and pays the taxes on the US level. So then it avoids the investors needing to file taxes. So we learned a lot on the job. So we have the security compliance side, the tax side, the structuring side of things. And then the next, really going down the bullet points that I talked about, we can also talk about the culture. There's a different investing culture when it comes to Canadian investors and U.S. investors. U.S. investors are, in my opinion, more entrepreneurial. And we're talking about apples to apples. So if you have a high income, a professional in Canada who makes the same income as this U.S. counterpart, the U.S. investors are more inclined. They just take a little bit more risk, in my opinion, that are their Canadian counterparts do. With the Canadian investors, we've been on multiple calls with them, they've nurtured them for a couple of years, and then finally they, dip their toes in the water and invest with us. Whereas the U.S. investors on our call with us, and it's like, what's your minimum? 50? Put me down for 100. I'm making a total joke out of this, but yeah, overall, we feel. In our data we've collected, U.S. investors are more open to making these types of alternative investments.
Interesting. Yeah. So I've had that question come up a lot of times, and I've known that there are a lot of complexities behind it. I've not actually brought any Canadian investors into my deals, and probably because of all of the complexities that you shared. What I'm hearing from this conversation is if I run into Canadian investors, I should just connect them with you because you already have the systems in place, the entities created, and you understand the structures. In fact, I can think of a couple off the top of my head that I'll have to make some intros for you after the show. Okay.
Sure. At the least, give me a call, or if you're listening to this show or you're watching this, give me a call, and I can provide some blood, sweat, and tears lessons that I've
Sure.
learned over the years to see what makes sense for you as well. Not necessarily just sending the investor to us, but at least get some guidance. And I'm
Sure.
happy to connect you with the right people.
Yeah, absolutely. Now, I know in our space, there's this big discussion around bringing other international investors into our opportunities. Have you taken the skills and knowledge that you've learned around bringing Canadian investors here to potentially China or Japan or any of the other Asian cultures?
Yeah, so the research we've done and the tax memorandum we've received, the instruction has been given to us that if we are looking to bring other international investors into our U.S. syndicated deals, is number one, making sure that the resident country that our investor is coming from, that there is a tax treaty with the U.S. that we're not triggering any sanctions for those countries, so making sure that there's no issues on that side of things. But the second instruction is that the preferred way is that the international investor invests through our Canadian feeder fund rather than going directly to the U.S. master fund. So
Interesting.
looking around the space, other groups that I've worked with, investors from Vietnam, for example, they brought those investors through their Canadian fund to invest into their U.S. master fund. So currently, we don't have any investors that have invested from other international regions. We do have investors who are residents from other regions who currently reside in other regions, but they also have their Canadian citizenship. So even though they're abroad, even though they have dual nationality, they're still making their investment through their Canadian nationality.
Interesting. Okay. Yeah. Sorry to go down the wormhole there. It's something that I've spent and been a part of a number of different conversations over the last handful of years. And there doesn't seem to be a lot of good direction there. So it's good to know that we've got an expert in the space that I can refer folks over. Obviously, not to fill your calendar with admin work, but hopefully some potential there.
Sure. Just briefly, last point on this. So you
Yeah.
got 13 to 15 million US accredited investors. You have the largest economy in the world by far, 350 million people living here. They're right in your backyard. If you're a US investment group, keep your focus on the US, adventuring into across the world, trying to learn the complexity. It'll be a lot easier learning, raising money from US investors. Look at CPI. Our focus has now been more on U.S. investors than Canadian investors, even though we're from here. So just that gives you some information.
Makes perfect sense. Perfect sense. Well, let's shift if we can. Obviously, you've been in the space now for about 5 years as a syndicator. What does the organization look like today? I know you're involved in the BTR space, so maybe we start there.
Yeah, absolutely. The organization, I mean, we started through COVID. So we learned to utilize contractors, service providers, partners from all around the world. This idea of being in the office was not possible. So we learned, our company initially learned that most of our service providers were all the way around the world. And since we worked in Canada and the US, so we got comfortable with that process. So even our executive teams are from Toronto, from Denver, from Calgary, from Vancouver, from Naples. So that's really how we've structured the company. Another way is item to note on the building the right team is if your executive team members have a stake in the company, if they have a partnership, it always serves the company long term. So that's how we've built it. All of our executive team members have a ownership in the company, which they have vested interest rather than being paid employees. They're actual company owners. Talking about build to rent, yeah, happy to get to you about this fascinating asset class, build to rent. It's become very common lately, the name build to rent or BTR SFR in the US. I'll give you guys a quick background. So post GFC, great financial crisis that happened, the mortgage fiasco, institutions, large Wall Street institutions realized that U.S. single-family homes were selling pennies on the dollar. They realized this and they knew that the market would turn. Real estate is cyclical, that this cycle will also pass and they can sell those homes for a great price. So they start buying tens of thousands of homes. This is scatter sites. They're not just they're portfolios of single-family homes. Buying these, and the plan was just to hold and sell it when the market cycle changed. What they realized, and this is large private equity firms we're talking about here, what they realized is that single family homes as a portfolio, they really behave like multifamily. They behave like they're basically horizontal multifamily. So they start buying more and more of these single family homes. Around 2013, possibility of buying these homes for pennies on a dollar was no longer available. The market had turned, but they still really liked this asset class. So they started actually partnering with developers and building communities of single family homes for the purpose of rent. So that's kind of the spawn of build to rent asset class. That's kind of a subcategory of multifamily, in my opinion, anyways, under the commercial real estate umbrella. And they started building these all over Phoenix, in Dallas, in Vegas, in other regions, in the Sunbelt regions. Rather than building these garden-style multifamily properties, they were building communities of single-family homes. Some of the positives that existed in this space were, in this particular asset class, was that everybody living in this community who wanted to live in a single family home and rent a single family home, they were amongst other renters. Because a lot of times when you rent a single family home, you're in a neighborhood, you're quote unquote the renter while other people own. So there might be you might be looked at a different way in some cases. I don't know why, but that's the complaint. So when you're living in a community of single family homes, you're amongst others who also rent. It will also serve a different demographic. Rather than being renters by necessity, these individuals were renters by choice. They wanted to live in a single family home. They wanted to have a garage. They wanted to have the backyard. They didn't want somebody living above them, below them, next to them, but they still wanted to kind of be able to rent because they also wanted to be mobile. If they wanted to live somewhere for a couple of years and then move to a different region, they could achieve that. So it served that a certain demographic, the renters by choice demographic. And what institutions also realized was that the tenants in built-to-rent communities were more sticky, meaning that they stayed longer than their multifamily counterparts. They also had less delinquency, and there was less issues with them not paying rent or having to be removed from the unit or what have you, go through the process that exists. And so that was kind of the quick background about build to rent. I've always looked at this asset class. I felt that as the U.S. is becoming more and more a renters nation by necessity, but also a lot of people, certain demographics, younger generations, they're becoming that subscription-based generation where everything is a subscription, including rent. But now they don't have to be living in an apartment. They can live in a beautiful single-family home. So I'm personally bullish on build-to-rent. So is CPI, our firm. That was a little background about what build-to-rent is and how it operates, but tell you a little bit about how build-to-rent can be invested in or how it can be structured as a general partner or as an investor. So one option is to partner with a developer, buy a piece of land, build this community of single family homes. The sweet spot is around, let's say, 60 to 80 doors. That's just because of management and other reasons. The idea is buy a piece of land, partner with a developer in a growing market, build this either duplexes or single family homes. And then after the build is done, stabilize it, bring in renters, bring your occupancy above 90%, and then sell this community to an institution who's looking for these types of investments, which is they're safe, they provide great cash flow, and so on. That's one model. The other model is purchasing a value add built to rent, where a built to rent somebody has owned for a few years. Now they want to exit, they can sell it, and there is a value add component where you can do certain upgrades. Our current deal is actually a very interesting deal. Is we've partnered with a developer in San Antonio. We're building 30 duplexes, 60 doors. But the business plan is that these units are going to be sold to investors who are buying the units for cash flow. These are not LP equity investors. These are investors who are just looking for cash flow units. They're being pre-sold to investors. And by the time the project is done, they've all been pre-sold, turnkey to the investors. And then the GP and the LP, who are the equity investors, they exit the deal and make great economics. So it's somewhat of a unique model within the build-to-rent. But that was a little background about build-to-rent, where it came from, and how a build-to-rent deal could be structured and put together for LPs and GPs.
Yeah, that's amazing. So yeah, I've not heard of the last example that you shared. I've heard of other operators that build those, and I suspect, I guess they must have been syndicated. I just assumed that they were being sold by one company. So that's very interesting. The thing, sitting here in Phoenix, I actually had a lot of clients back in my days at American Express that were actually these build-to-rent operators here in the Valley. So I kind of got to see this progress, and Phoenix and Arizona as a whole became kind of like the mecca of build to rent here in the Southwest, from my understanding. Now, I believe you did some projects down in Tucson. You've done some others in Arizona as well. So you've been doing build to rent projects for a number of years, correct?
We have our Tucson project actually never ended up going through. That was a bit of a different model. The idea there was we
Okay.
would approach a developer who was building a community of single family homes, who was planning to sell these individually to people who wanted to either live or rent them out. We approach them and say,
Okay.
hey, rather than selling to an end buyer, we'll buy all of them for you at this stage. We'll complete on the home at certificate of occupancy. Unfortunately, when we went under contract on that deal, that's when the Fed started increasing interest rates. So every few weeks we were re-underwriting. And at some point the deal no longer made sense. So we had to walk away from our Tucson deal. But it was always there, the interest, the excitement, the enthusiasm to be involved in a build to rent deal since that day. And I've written a bunch of articles on build to rent since then.
Okay. Yeah, fantastic. So, well, let's do this then. What's the portfolio look like today? You've spent 5 years. You've done a ton of research in the BTR space. Does it look like a full mix between BTR and multifamily? What's the total portfolio look?
Yeah, the portfolio currently is all multifamily value add. We have just gone under contract on our first build to rent deal, and we're closing end of this month. It's a syndicated deal where we have both Canadian and U.S. investors participating. It's a deal in San Antonio that I told you about. But yeah, that's really where we are. And keep in mind, when we talked about the Tucson deal, when that deal fell out of contract, CPI actually didn't do a deal for 24 months. And, in retrospect, it was the right decision not doing a deal. Obviously, as a nimble, smaller group, it's a lot easier to keep the lights on without having to do deals and getting those fees coming in. But we were able to be patient and not do a deal for 24 months, hence the portfolio size not being as large as
Sure.
expected.
Well, but they say like the best deal is the bad deal that you don't do. So sitting on the sidelines for 24 months, and I would say they were critical 24 months. So kudos to you for having the wherewithal to sit on the sidelines, because that can be really uncomfortable. I understand that. So, well, very good. So can you share details? I suspect this is a 506C offering because we've talked about it here today. Can you share high level what the metrics look like and what the return structure looks like for investors?
Yeah, absolutely. This deal has great economics for the LPs. Is 28% IRR, around 27% average annualized returns. Is an 18-month exit. Again, the units are being pre-sold, so it does reduce risk in some aspects. Is in a great area of San Antonio, West San Antonio and Helotes, which is just a 15-minute drive from downtown San Antonio, 15-minute drive from the airport. Great developer partner that we've now been chatting with for over a year, based out of San Antonio, great family business. Yeah, those are the details. But we're looking to do more deals. So by the time this comes out, the deal has been closed. But yeah, we're looking to do more deals with our developer partner and build our footprint in San Antonio as well.
Fantastic. It's amazing market. We've done at Impact Equity, we've done a number of deals in San Antonio as well. I've been watching this BTR space for years and years now. I'm absolutely fascinated with it. I love the fact that it handles this, maybe not affordable housing challenges, but it certainly handles the housing challenges and some of the alternative housing structures that I think we're going to see more and more about. So really exciting to learn more about this space from you, August, and teach our audience as well, because it sounds to me like BTR is here to stay. And I think we're going to see more and more of this. And I'm so excited to see you continuing to be involved in the space, because I've watched you and your wife on the sidelines for a few years now and just been thoroughly impressed with what you guys are doing and what you put out there. So thank you so much for coming on the show and talking about this new exciting space.
Of course, my pleasure. Thanks for having me.
Awesome. Well, hey, before we wrap up, I do have a couple of questions I like to ask everybody. So let's jump into those real quickly. For the new or newer passive investor, is there an educational resource that you would point them to or suggest that they go to learn more about this passive investing journey?
Yeah, absolutely. Rather than giving specifics on a certain podcast or a certain book or other information, I would say immersion is the most important part. If you're looking to invest in real estate passively, if you're looking to invest in any type of asset class in a passive nature where somebody else is managing the deal for you, is understanding the mechanics of what you're investing in, what you personally believe in. If a multifamily deal comes across your desk or build to rent deal comes across your desk, does that align with your vision, with your belief? Do you feel that that's a bullish market? You might understand or believe in Bitcoin, for example, more than you believe in real estate. You should focus on Bitcoin, or if you might understand in equities more than you understand real estate. Invest in something you believe in long term, and then find the right jockey for the job. And nothing is wrong with interviewing as many people as possible. If transparency is probably the most is one of our values that we follow, part of the entrepreneurial operating system from the traction book with CPI. But yeah, the transparency is super important. That should be one of the red flags. If you're talking with a general partner, and doesn't matter what asset class, if they're not transparent, that's probably somebody you don't want to work with. But immersion is the key. Understanding the asset class you're investing in, believing in it, not just being sold because somebody said it's a great asset class, but coming to your own conclusion would be my advice.
I love it. And yeah, I think, we get stuck in this idea where it's like, I decide I want to do something, give me a book, I'm going to master it, I'm going to jump in. But you just simply cannot master and gain enough information from one book, one podcast, one suggestion. So I love the idea of complete immersion, because ultimately, if you're putting your hard-earned dollars at risk, it makes sense to jump in, go all in, and learn everything you possibly can. So great advice, August. Now, a little bit different question here. Are there books and podcasts that you're reading currently that you're really excited about? Something you'd care to share? And it doesn't even have to be real estate related.
Sure. Yeah. No. As far as a podcast that I listen to on a regular basis to gain knowledge in the real estate space, aside from the podcast that I host myself, Real Estate Investing Demystified, is the Great Capital podcast by Spencer Gray.
Okay.
It's a weekly podcast that him and his partners do. Is very informative, very detailed. I would also say John Chang with Marcus and Millichap. They have a great. It's not a podcast, it's more of a YouTube show. So it's a weekly show that comes out, covers many different things across economy and different asset classes. So if you listen to those two every week, one of them is an hour long, the other one is around 5 to 10 minutes long, you get a good hang of what's happening in commercial real estate space. So that's my recommendations.
Love it. Love it. All right. And then a good due diligence question. And if we could maybe steer this towards the BTR space as well, since that's a newer asset class for us. So maybe one or two great due diligence questions that passive investors should be asking.
Absolutely. I mean, again, if you're past that stage of believing in what you want to invest in, you've understood the asset class, and now you want to, let's say, invest in a BTR deal or in a multifamily value add deal, this sponsor, the investment group, is a very important part. Keeping in mind that alternative investments are not the only way to have exposure to BTR or to multifamily value add. You could achieve that exposure through public markets, through public REITs. Obviously, the returns are much lower, and you're just another number on a long list. Whereas with alternative investments, with the private placement world, you're very up close and personal. In a lot of cases, you're talking to the executive team, possibly the CEO, possibly the chief investment officer. So you can pick up the phone, literally call the guy and saying, "Hey, what's happening with my deal? I didn't see my distributions in my account this month," and what have you. And it gives you a good feeling, because now you're part of a company that's being built from the ground up, and you're kind of in that early stages of some of these great companies and individuals who are out there. So it's more intimate type of investing when you do invest in alternatives in the private placement world. But yeah, due diligence, it's really your gut feeling as an investor. We all have our own spidey senses. There's certain people that we align with. From some of the greatest people within sales is, they always give the advice that on the selling part, that you're going to have your raving fans. There's going to be a group of people that just love you, want to invest with you, want to partner with you, and there's a group that just absolutely despise you for no reason, and then there's people in the middle that you could possibly bring on your side. But you want to find that group that love you and want to invest with you, want to deal with you. On the investor side is the same thing. Find somebody you enjoy. Find somebody that you want to work with. Even if something goes wrong, at least you're stuck with somebody who you enjoy spending time with, rather than somebody you actually hate and you only invested with them because other people said they were great, but they don't have that kind of alignment or that synergy you feel. So invest with somebody you enjoy spending time with.
I love it. Yeah, great advice. Like, there are so many operators out there, and there's so many great operators out there as well. These are sometimes 5, 7, 10-year relationships. So just take the time to find people you enjoy hanging out with. I can't stress that enough. That's a great advice. Thanks for sharing that. All right. So we have a couple of fun ones here just to get to know you a little bit better personally. So is there a recent bucket list item you've checked off your list, or one you hope to in the near future?
Yeah, absolutely. I always had this dream about Ivy League schools, and I never got a chance to really go to an Ivy League school. But recently I applied for this program at Harvard, which was private equity venture capital. I was accepted into the program, and I just attended Harvard for the program. I was surrounded by 65 other individuals from all around the world. Only 8 of the 65 were from the US. The rest of them were from all over the world: Europe, Middle East, Eastern Eastern Europe, South America, Mexico, all over the world, Brazil, which is also in South America. But yeah, it was an incredible program. Our professors were incredible. Some of them were sitting on the board of Carlyle Group, which is a large private equity firm. But it was a great, way to learn more about the space I'm in. And I asked a question from my Professor Lerner, and I said, hey, describe CPI a bit. And I always wondered, am I in real estate or am I in private equity? I always kind of wondered about that question. And I asked him the question, and I described CPI somewhat briefly. And he said, he didn't give me a straight answer, but it leaned much more to me being in private equity than being in real estate. And the example he used was Blackstone, which they have billions of dollars in allocations in real estate, hundreds of billions of dollars in allocations in real estate, but they're a private equity firm. So I'm officially in private equity business, and I got my certificate, went to the clothing store there, bought a bunch of Harvard Business School gear.
Sure.
Yeah,
You're now an alum, right?
That's right.
Yeah,
exactly.
very good. Well, congratulations. That is what an amazing accomplishment. What a great experience to be a part of that group and to get to meet all those folks from all over the world that are doing this. That's amazing.
Absolutely.
All right. Final question here then. If you had, August, $100,000 you needed to place an investment today and you couldn't put it in your own deal, where would you invest that $100,000?
Ooh, what a great question. What a great question. $100,000 investment today to make one investment. Why don't I just open up my mind and give you a few options that exist? I always felt if I had some cash sitting around and I just needed to find a home for it for a few years, what would it be? One of the options always was a debt fund, or as it's known in Canada, a MIC, Mortgage Investment Corporation, because debt funds, particularly the ones that are managed really well, they don't go above 70% LTV, 70% leverage, and their team that finds these borrowers are incredible. So even though the returns are not as high as returns offered in syndicated deals, they're a great place to secure your funds. Another option is obviously index funds. Index funds have their level of liquidity. They are somewhat volatile. Interestingly enough, long-term index funds like S&P 500 or NASDAQ, long-term, they give you great dividends and great returns and growth. But if you come in and out in the wrong time, it could be terrible. Depending on what your timeline is, index funds is an option. I would also say, obviously, syndicated deals, it should be on that list as well. Syndicated real estate deals are great investment to be part of. Stock picking, I definitely wouldn't recommend. Cryptocurrencies, my recommendation is a small percentage of your total net worth should go towards cryptocurrency. So probably around 2.5% of your total net worth, in my opinion, should go through cryptocurrencies. Now, if that grows because the cryptocurrency went up, that doesn't mean, I'm talking about if you're getting into it, it should be 2.5% of your total net worth.
Sure.
Another answer to that is also investing in yourself, really investing in your education. The Harvard program definitely wasn't cheap, but I felt the knowledge I gained and the people that I was able to, my classmates and people I was able to connect with, that's worth much more than what the investment was. So investing in yourself. Also, like my good friend Dave Wilcott says, is investing in your health. He puts aside $25,000, and I hope he doesn't mind me talking about this, but he puts aside $25,000 a year every year that he has to invest into his own body because he's planning to live 140 years or what have you. So investing in your health. Everything we're talking about is absolutely pointless if you don't get to enjoy it. And it's not about how long you live. It's about how you live till, your senior age. If you're bedridden and you still live to be 90, that wasn't really fun for the last 20 years, right? So it's about how you live. So investing in your body is a huge part as well. So there you go. That's a diversified strategy there, Randy.
Yeah, that was fantastic. I think if you had $1 million, you could follow that strategy and do very, very well. So, well, very good, August. This has been a lot of fun. Always enjoyed talking to you and learning more about what you're doing. Super excited to hear about San Antonio, the market that you're choosing to really go deep with BTR. So for the audience, if they want to figure out how to connect with you or hear more about what you're doing, how can they find you?
Of course. Yeah, I'm very active on LinkedIn. So August Biniaz, I'm the only August Biniaz in the world. So August, like the month, Biniaz, Biniaz. Check me out on LinkedIn. Send me a connection request. If you want to ask me something, just send me a message. Tell me you saw me on the show. Our website, cpicapital.com. And just reach out anytime. Happy to connect.
Fantastic. Awesome. Well, thank you again for being on the show. This has been a lot of fun, August. Thank you.
My pleasure. Thank you.
Awesome. To the audience, as always, we encourage you to continue that education journey with passive investing. But more important than that, we encourage you to make the decision to make your first or your next passive investment. Both August and I are convinced that once you do, you will just wish that you had started that much sooner. So be sure to join us again next Thursday for another great episode. Don't forget to like and subscribe wherever you're listening. And thank you again for joining us here today.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.